Good morning, traders. We're back again for some of the most important pieces of U.S. stock history. Here we have the cues which represent the NASDAQ market. As you can see here, we have a hard dip which normally results in a bounce. 2 weeks ago it opened up at this silly price and ran way up and went here. Now this has become a new point of resistance temporarily. Okay, we knew it wasn't going to just bounce from here because the bars are far too wide, you see. And good traders are not going to buy anything off of a very wide bar because risk becomes far too great. Okay, a real trader is going to look for something like, around this area here, very little risk. The bar is small, so we can put a stop here a little bit above it. But here, you see how much your risk would be, just $6 worth of risk. That's insane. Now here, it had a little bit of a low. It tested it, people bought it because they knew that most likely it's going to go right back up. And these are more of investors. Most traders won't do this. It's not a trading principle, but if you've been in the market long enough, you realize that a lot of people are going to buy here, and you'd buy just a tiny bit here and put a stop way around here somewhere and hope for the best. And that's what a lot of people did. I'm not advising you to do that. Okay, now, here is this week of November, and it opened up way up here for some reason. Basically opening even so far. And this is just the morning session. The full session hasn't begun yet. But still you have this long bar, and it's a real chance you're taking to go ahead and buy at this point. Better traders are going to wait until that volatility decreases because volatility is far too high. A bar like this means that there's a lot of buying pressure and very little selling pressure left. And the same with the red bar. It means that there's a lot of selling pressure, very little buying pressure there. So it's still a wide bar, and your risk is quite wide. It's not the best, and you can wait. It'll take its time. Your potential limit is either at the top of this bar or at this 20-period moving average, which eventually may coincide with each other. A lot of times, sooner or later, this 20-period moving average is going to catch up with this stock because it is oversold at this point. The entire U.S. market is oversold. Okay, let's move on to the NYSE markets. We use the SPYs to take a look at that. Here's basically the same situation, except there never has been a buy signal generated. One may or may not be generated today. There's no pre-market special anything going on here. Same scenario, except you can see here the low was held. That is extremely important. In the same scenario, when this made this humongous low, and a couple of weeks passed, people bought it and they kept it up, and they had a little bit of risk here, and they only put a little bit in. No smart individual will put a humongous amount of buy shares into such a strong downtrend. Okay, and the traders are still waiting for a nice, reasonable, small bar to get in on. And if and when that happens, it'll probably jerk right back up for a nice little profit, maybe a 2 to 6 to 1. We don't know. We shall see. Okay, we drill down on the SPYs. We'll go back and do the Qs later. You can see here that it has achieved near this resistance, and it's above the 20-period moving average. Now, it could consolidate here. That's what everybody is hoping for, because that means the economy could, should, would get better, and then break out north and travel a little bit until maybe this resistance point. See? That's a whole nother resistance point there. So, your potential is from here to here, and then you look at getting back out if you're just dying to go long. Okay? And by then, maybe even this 200-period moving average may meet it right in this area, because this is real resistance, and this is just a line. Okay. Now let's go over to the Qs and look at its daily. It's probably pretty similar. Of course, normally if the NYSE does bad, the Qs will follow. Normally. Many times it doesn't happen that way. Okay, here is the same scenario. Got a tiny bit of resistance here, tiny bit here, and a good bit around this area. Right around here. Okay? And same scenario with 200 period moving average. It's looking pretty nice. So basically, we don't really know where it's going to go. If I were you and you wanted to buy something, I would wait until volatility got lower than this. That's high. If you are risky, if you are just a pure trader, you can buy over this last bar. Since this last bar did exceed this other bar, you can buy now and put your stop at the bottom of all this. Okay? That's what you can do. If you really just want to go off principle alone, you can buy right now and put your stop at this low. Of course, if this week just kind of hovers around here and then it cracks back down, people are going to sell again. It's going to be under selling pressure. And from that, you know, I and other smarter traders are going to judge the amount of selling power left in this market by how far it can push itself down. And if it can't push itself down to break this low, then when it turns, it's worth a buy due to the humongous, hard, fast drop. Okay, traders, if you have any questions, you can contact me and we can get in the trading room and teach you how to do this from day to day. All right, have a good day. Goodbye.